So today we're going to go over what is a DSCR loan and what are the 5 keys to get approved. So first of all, what is DSCR loan? A DSCR stands for debt service coverage ratio. Simply put, does your income cover your expenses? At least the 5 expenses that underwriting looks at. We're going to go through those in a little detail later. DSCR loans are for rental properties only. It's one of the simplest loans for real estate investors. It really takes the income off the investor and puts it on the property. And this opens up excellent opportunities for investors. They don't have to wait because they do not have to use personal or business income or go through all the hassles of being in business 2 years. This loan is built for rental properties that stand on their own. So what are the key points? Number one, it has to be rental ready property, something that someone could move into. So it's not a property that is designed for the start of a BRRRR process. Number two, the income is based solely on the property. So it does not matter what your personal income looks like, your business income, doesn't matter if you have a job or you're retired. The income is focused on the property. Like I said before, as long as the income, the rents from that property are equal to or greater than the expenses, the income is good for this deal. Next up is credit score. Credit score matters with DSCR loans. The better the credit score, the better the rates, the better the terms you're going to get, and actually an easier process the better the credit score. Next up is it is a rental property, so you cannot live in any of the units. If it's a duplex, you cannot live in one side of it. DSCR loans must be used and the whole property must be used. The last point is the appraisal is very key to underwriting because they're going to check and verify the value, but they also check and verify market rent. Remember, the focus of a DSCR loan is the income from the property. So they want to make sure the income, the rents that you're using are what the market is offering for rents and rentals only. These are basic 30-year mortgages. They are first liens on the property. They do have prepayment penalties, unlike some of the conventional bank loans, which just means for 2, 3, 4 years, if you pay them off, you're going to have to pay 1, 2, or 3%. They can be used for purchases, cash out refinances, rate and term refinances. They can be closed in your personal name or an LLC or other business. You could buy a property out of state, in state. Wherever you can find a property that qualifies, especially on the income side, you could use a DSCR loan. In essence, DSCR loans are the perfect loan for real estate investors. Doesn't matter if you're starting out or experienced. So key number one we talked about before, but do the rents cover or are they greater than these 5 expenses? First of all, the new principal and interest for the loan you're about to take out. This is where that rate comes into play too. You want to lower the rate to keep that, principal and interest on that mortgage payment down. Number two, what are the current taxes? If you're in most counties, states like the rest of us, those have been inching up the last, 3, 4, 5 years. So check the current taxes on that property. Next up, number 3 is the current insurance. Make sure you reach out, find out what the insurance is on that property so we could figure out what's the monthly cost. For HOA, it's not for every property, but if you do have a homeowners association and you have a dues that comes with it, that is one thing that they will add to the expenses when they're seeing if a DSCR ratio works. And last is flood insurance. If you're in a flood zone and yet the government requires you, the underwriter requires you to get flood insurance, you're going to have to put that into your calculations. What are the things we didn't go over that you see in other loans or even when you're doing ROI or cash on cash returns and all these other numbers that you're coming up with? We're not talking about utilities, even if you pay for them, trash, electrical, gas. We're not talking about maintenance or maintenance reserves. We're not talking about property management fees or even vacancy fees. Remember, DSCR only looks at those 5 expenses and does not worry about the other ones. So once again, if rents are equal to or greater than those 5 expenses, the income is good for that property. And don't worry, we've made it easy for you. We put a calculator link below. You just put in a few of those numbers, hit enter, and in 5-10 seconds, you can find out if that property qualifies income-wise for a DSCR loan. The next key you need to understand when you're looking at a DSCR loan is credit score. Credit score matters with a DSCR loan. The better the credit, the better the terms, which means rate, loan to value, options, people competing. Typically in this market, a 660 will open the door. You could get a DSCR loan. But if you really want the good rates, you're going to have to be in the mid to high 700s. And if you look at something in this environment where you're at mid 600s, like a 660, which is the floor, the maybe 100 points higher than that 760, it's at least a point difference in interest rate. Meaning you go from 7 to 6, and you may go from 75% LTV to 80% with a better score. The better the score, the lower the rate, the better the LTV and the terms and the processing. But another thing to understand with a DSCR loan, unlike other loans, if you have a spouse, if you have a partner in the ownership of this property, you can use most of the time, just depends on how much they own, you could use their credit score if it's higher. You could use the higher of the two partners, 3 partners, 4 partners, whatever it may be. Make sure you always have people in your properties, associated with your properties in the LLCs that keep their credit score high. It really matters in DSCR loans, conventional loans, even fix and flip loans. In real estate, we use money. We use it all the time. That's how we create this wealth. Make sure your credit score is as high as possible just to make this easier, more profitable, and actually a little more fun. So remember, you don't need perfect credit, but you have to have good credit. You can't have foreclosures, bankruptcies, but someone in your group should have a good credit score. Number 3, we're going to talk about loan to values, just to understand the loan to values that go with these loans. The basics are on purchases, it's 80% LTV or lower, and on rate and term or cash out refinance is 75% or lower. Now, those are just the basics. Yes, there are some, instances where you could get 85 on purchases and 80%. You're just going to pay a little bit more, pay a lot more, and also have to have a better credit score. And just to make sure everyone understands loan to value, when I'm talking about loan to value, remember as a lender, what we look at is what amount are we going to lend on a property. So typically what that means is they take the appraised value. Say the appraised value is $300,000. And they're going to say, we're going to lend 75% LTV loan to value. That means they're going to lend 75% of that $300,000. So $300,000 times 75%, $225,000. That's the maximum they're going to lend. They're going to lend that or below that. They're not going to go above it. So understand your LTVs before you jump in, buy a property, get a property. If you don't understand any of these things that we've gone through, just leave something, a little message in the comments. So number 1 is know your income on the property. 2 is your credit. 3 is your loan to value. Number 4 is just the property itself. What kind of property are you looking for on a standard DSCR loan? Standard DSCR loans mean they cover, units that are 1, like a single family, all the way up to a 4-plex. So anything from a single family, duplex, triplex, even a quad. So you have to make sure it's one of those properties. Once again, you cannot live in one of the units. Number 2, a lot of lenders, when you get into 3 and 4, may cut back the loan to value that they're going to give you. It may be 75% on the purchase instead of 80. Understand the rules for you, your credit score, and anything else that you need for underwriting to make sure you're getting and can purchase the property you're looking at. Commercial properties over 5 units will have a different underwriting guideline. 80% of the loans out there for DSCR are for 1 to 4 units, but the best pricing really is on a single family, which is a single unit property. And the last key is reserves. They want to make sure you have some money available. They're not going to ask you to, send it to them, put it in an escrow account or anything else like that. They just want to make sure you have some savings, some retirement, some money in an investment account that equals 3 to 6 months of that payment. Why? Because it's residential real estate. Things happen, vacancies happen. They want to make sure you have enough to cover a little blip in the rental market. So they want to make sure you have some reserves. So make sure you have reserves in one of those, liquid kind of items, which is savings, investment accounts, mutual funds, IRAs that equal at least 3 months. Sometimes they require 6 months, depending on your credit score and how many properties you have out there. Another key with reserves is if you're doing a cash out refinance. So you have a property and you're refinancing it, getting some cash out. In most cases, you could use the cash out for your reserves, but they're always going to look for some kind of reserves. And it's not to punish people. It's not to, make sure you're saving. It's just to make sure you have a cushion for when the inevitable happens, you're going to have the money to cover that payment for 1, 2, or 3 months. So those are the 5 keys: the income of the property, your credit score, the LTV, what kind of property it is, or 1 to 4 units, and making sure you have reserves. What DSCR does not care about, remember, is your income, your business income, how long you've been in business, even if you have a business account, if the property's in an LLC instead of your personal name. It does not care about these things. It only cares about what we've gone through as far as the keys. So why are DSCR loans, again, great for beginners? Because I've seen people start out, no experience, no business, just wanting to get into rental properties. They have good credit. They found a property that has good income and they have some reserves. That's all it takes. You don't have to have experience. You don't have to have 3 or 4 properties. You could count the rents right away. Conventional loans don't allow you to count the rent right away if you're new, because they want, 1 to 2 years experience before you start counting rent. Fewer documents, cleaner rules, just a simple loan. All you have to do is understand these few items that we went over today. Review this, look through it again. Make sure you use the calculator below. Just put those items in. Test every property you're going to look at. And what I mean test is run the real rents, run the real taxes and insurance. Make sure it qualifies for the loan amount you're looking for before you put it under contract, before you start talking to lenders. Make sure you know your numbers and be prepared. It's only 10 or 15 seconds of your time to run that calculator. So run your numbers, subscribe to this channel, like this video, and we'll see you next week.